When a country is losing many billions of dollars on trade with virtually every country it does business with, then in that case, trade wars are good and easy to win. And so it began. With that tweet, Donald Trump gave his rationale for a plan to impose tough tariffs on steel and aluminum, and this was announced back on March 2nd. Since then, his tit-for-tat sparring, especially with China, has kept Wall Street reeling. Where is all this headed, and what could it mean for everyday investors? It's now time once again to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional-style investing to your portfolio. Hello, I'm David Scranton. We've done a few shows now on market volatility and what's been driving it. And what's been driving it most recently are President Trump's words and actions on trade. So far, April has been a non-stop roller coaster ride for Wall Street as the president and China swap escalating tariff threats, and economists subsequently warn of possible dangers of a trade war. So the question becomes, how do we get here, and where is all this going? And what are the potential pros and cons for the economy as well as for investors in the income generation like you and me? We'll sort it all out for you today with the help of our guest, Gordon Chang, author of The Coming Collapse of China, and Jeff Small, author of Turning Financial Planning Right Side Up. But first, let's talk about how we got to where we are now and where it could lead. So the question becomes, are trade wars good and easy to win, as President Trump tweeted on March 2nd? Well, most economists would say no, that there's more downside than upside potential to a trade war for all involved. But you could argue that the motivation behind the president's initial announcement about tariffs was good or well-intended. The total U.S. trade deficit stands at $566 billion, which shows that our country imports hundreds of billions of dollars more in goods than it actually exports. As the president and many others see it, that's largely due to bad trade deals that have been made in the past. Those have created an unbalanced tariff system, in which other countries impose larger tariffs on our products than we do on theirs. So what is a tariff? Well, simply put, a tariff is a tax or a duty charge. And for example, if we're paying a 20% tariff to export a product, but let's say only charging 2% to import the same product, obviously that's a huge financial advantage for the other country's export industry over ours. So reforming international trade policies and rebalancing the tariff system could help us lower that sky-high trade deficit and add to our own GDP growth. This, of course, are President Trump's goals. And in no uncertain terms, he has singled out China as the main beneficiary of unfair trade policies and called for new tariffs on $50 billion worth of Chinese imports. Specifically, he's imposed new tariffs on Chinese steel and aluminum and called for tariffs on over 1,000 other Chinese imports, including flat-screen televisions, medical devices, aircraft parts, and batteries. He's also blocked Chinese takeovers of U.S. companies and ordered an array of tariffs against other countries. Now, many countries have since retaliated, including, of course, China, which has called for tariffs on 128 products imported from the U.S. Many products on the list come from states that favored the president in the 2016 election. That's significant because if President Trump, if it gives him incentive to try to resolve this whole issue without hurting, farming and manufacturing economies in his base states. Taking cue from China, the European Union has then also threatened to hit back where it would hurt the president the most. They've called for tariffs on $3.5 billion worth of American goods, including certain brands of motorcycles, blue jeans, and yes, even whiskey manufactured in red states. As all of this has unfolded over the past 6 weeks, Wall Street has reacted with interchanging bouts of panic and then relief. We'll talk a lot more about this and just why this has happened in just a bit. But first, let's try to answer that question: is a trade war a good thing, or could it potentially be a good thing? Well, despite all the worry on Wall Street and warnings from economists, there's actually a scenario in which a whole situation could end up being good for the United States. If we do manage to get the tariff system balanced, meaning no country's export industry has an unfair financial advantage, that could certainly open up some very positive economic opportunities for us. Obviously, it could allow us to increase our export business relative to imports, helping us minimize that out-of-control trade deficit. And with Chinese imports diminished or significantly more expensive, that could increase the demand for American-made alternatives here at home, a demand that could not only help existing companies, but also create opportunities for new ones. Now, granted, a diplomatic resolution that creates a balanced tariff system is a long shot. And if it doesn't happen, then in that case, the best we could probably hope for in this whole trade conflict is that it ends in a draw. How would that happen? Well, that could happen if the tariff war remained a tit-for-tat kind of thing, as it has so far, where for every damaging tariff we impose, China, for example, imposes one equally damaging to us. Ultimately, we break even. But even that break-even scenario only works if American consumers then substitute the Chinese products instead by buying American-made products once these Chinese products become too expensive or no longer available. If instead, however, Americans opt for European imports, that might be, let's say, still available and still affordable. In that case, we would not break even. In that case, we would lose because of the trade war. So yes, a trade war is theoretically winnable, but is it easy to win? Well, I guess that depends upon your definition of easy. See, by and large, the very idea of a trade war is alarming to U.S. business leaders. A reason for that is history. Generally speaking, trade wars of the past have not been good for the global or domestic economy. In fact, when George W. Bush raised steel tariffs in 2002, for example, the GDP declined and the United States lost about 200,000 jobs. An even worse example is the notorious Smoot-Hawley Act, which was passed by Congress in 1930. This virtually destroyed global trade and is widely blamed for deepening the Great Depression. So, what are the potential economic pitfalls this time around? Well, take those steel tariffs, for example. In the United States, there are more people employed in industries that buy steel to make products, such as cars, than in those where they actually manufacture steel. Tariffs could hurt them, and companies could pass that pain on to consumers in the form of higher prices. And if higher prices then hurt demand, that could mean layoffs and a major economic slowdown, possibly even another recession. Now, Wall Street has already shown this year that it's nervous about inflation and rising interest rates. If a trade war jacks up inflation, let's say, by increasing the cost of imports, it could force the Federal Reserve to raise short-term rates more aggressively than planned. And there are other potential impacts worrying the markets as well. We'll talk a lot more about those in just a bit. Now it's time to welcome our first guest, Gordon Chang. Gordon is a well-known author and lecturer whose books include The Coming Collapse of China, as well as Nuclear Showdown: North Korea Takes on the World. He has written and been interviewed extensively in recent weeks about the trade war threat with China. He's appeared on CNN, Fox News, CNBC, MSNBC, PBS, BBC. Whew. He's all over the place, as well as Bloomberg Television. That's a good thing, and we're happy to have him here with us today. Gordon, welcome.
Thanks so much.
You know, one of your most recent articles, you said that this isn't a trade war with China, it's something bigger than that. So what is it then?
It's a struggle for control of the emerging technologies, 5G wireless communication, quantum computing, quantum communications, and perhaps most important of all, artificial intelligence. Whoever is able to lead in these areas is going to have an important advantage in the next 3 decades or so. So it's very important for us to make sure that we protect American innovation from pernicious Chinese trade practices, which have been in place for decades.
You believe what President Trump has claimed about the intellectual property theft here in the United States by China?
Well, certainly. I mean, there's the IP Commission report. They did a 2017 update to their landmark 2013 study. And in the update, they said that each year the US loses somewhere between $225 billion to $600 billion in intellectual property by theft. Not all of that is China, but most of it is. And so we're talking about a grievous loss to the American economy and therefore to American society. You know, if we don't have innovation in our economy, we don't have very much of an economy left. So it's important that President Trump and everybody in the U.S., you know, join together to make sure that we have an economy that we can be proud of.
Absolutely. Now, you said that the United States holds all the cards in a potential trade war with China. How is this so?
Well, first of all, we're the trade deficit country. Last year on the merchandise trade deficit was $375.2 billion. You know, trade deficit countries don't worry too much about trade friction, but it's much more than that. So for instance, 2016, you had 68.0% of China's overall merchandise trade surplus related to sales to the US. And that number went up last year to 88.8%, showing amazing dependence on the US. We've got a bigger economy. You know, our economy is like 19.4 trillion. Theirs, they claim, is 12.8. Big economies push small ones around. And by the way, our economy in reality is growing faster than theirs. And last of all, we've got a stable economy and China has a fragile one heading to a debt crisis. So I would say that we hold the high cards.
Are you saying that their economy is really not growing at 7 to 9% a year? I mean, heresy you speak. Is that really possible?
Yeah, I mean, the last year for which we have a full set of statistics is 2016, where China claimed 6.7% growth. But in the middle of last year, the World Bank released a chart showing that China was growing at 1.2%. And if you think that's stunningly low, that number is consistent with the single most reliable indicator of Chinese economic activity, which is the consumption of energy. And in 2016, the consumption of energy grew by only 1.4%. So, you know, we're talking about a Chinese economy that maybe did a little bit better last year, but it's growing at a rate which is less than ours. And so this gap between China and the United States, it's actually getting bigger.
So in the 30 seconds or so we have left in this segment, tell us, is the president taking the right approach by playing hardball with China?
Well, absolutely. You know, we would like to have a generous approach to China, but we've done that for decades. It hasn't worked. We got to try something new. And that's exactly what the president is doing.
That's great. So trying to be friends with all the world then isn't the answer, as perhaps past presidents thought. I guess that makes some sense. Gordon, please don't go away. We have to take a commercial break. We'll be right back with more after the break. And you too, stay with us. We'll talk a lot more about the president's approach and how this could affect the economy positively or negatively. Stay with us. We'll be right back with more on the income generation. So just how nervous has all this trade war talk made Wall Street? Well, we actually did another show last week focusing partly on extreme levels of volatility, those that the markets have shown for over 2 months now. In the past couple of weeks, President Trump's tweets and rhetoric on trade and China's responses to them have been the main, I should say the primary drivers of that volatility. Recently, the markets finished yet another roller coaster week. And while part of it was blamed on a disappointing March jobs report, the main driver was another defiant Trump tweet about tariffs. When you're already $500 billion down, you can't lose, he wrote, referring again to the trade deficit he's looking to reduce. In a follow-up interview, he also admitted that he's aware that moving forward with his plans might cause, quote, a little pain in the short term, referring mainly to the potential impact on the stock market. I'm not saying there won't be a little pain, he said on WABC radio, but the market has gone up 40%, 42%, so we might lose a little bit of it, but we're going to have a much stronger country when we're finished, close quote. Hoping to calm Wall Street a bit, Commerce Secretary Wilbur Ross said investor reaction was overblown, adding that the president and the administration could try to resolve the trade dispute through diplomacy. It wouldn't be surprising at all if the net outcome of all this is some sort of negotiation, as he told CNBC. Whether it happens by May or some other time, that's another whole question. At the same time, other Trump officials reinforced that calming message, with Chief Economic Advisor Larry Kudlow saying that all the back and forth rhetoric might, quote, turn out to be very benign. And all the calming comments seem to work, prompting yet another cautious partial rally. But, as we've seen, things can change in a heartbeat. And if investors are indeed overreacting to all the tough talk and all the rhetoric, as Wilbur Ross suggested, it's because they know the markets are already in a very vulnerable state to begin with. I've discussed the reasons for this many times on past shows, the main one being that the stock market's artificially inflated and overvalued relative to economic growth. Big investors are finally ready to acknowledge that the markets need to make fundamental sense again. And as I've also pointed out, there are only two ways that could happen. First, by corporate earnings quickly catching up to the overinflated stock prices, or number two, by a major market correction that realigns stock values with today's corporate earnings. The first scenario, although it isn't impossible, it is highly unlikely. The second one, however, has indeed happened already twice since the year 2000. And stock market history says it's likely to happen again, and that it probably would have already happened if it were not for all the artificial stimulus pumped in the economy since 2009 that we called quantitative easing. Now, with all this in mind, it's not hard to understand why investors appear so fearful of the potential negative impacts of an all-out trade war. If the tariffs imposed remain this tit-for-tat system back and forth, the impact could drastically undermine the intended benefits of the president's corporate tax cuts, put the brakes on economic growth, and actually lower corporate profits instead of increasing them. So the bottom line is this. In its current vulnerable state, Wall Street is simply no longer able to shrug off bad or even potentially bad news like it's been able to do now for almost a decade. And, right or wrong, it appears to see the threat of a trade war as mostly a bad thing. So the question becomes, will investors ultimately be willing to give the president the benefit of the doubt that this will all be settled diplomatically and end up being good for America in the long run? And if so, for how long? Wall Street isn't generally known for being patient, and socioeconomic changes of this sort take time. If you've watched our last few shows, you know there is already a preponderance of evidence to suggest that the next sustained major stock market correction, one of somewhere between 40 and 70%, may be just around the corner, or even already underway. Most of that evidence is technical and fundamental, and it doesn't even take into account the many possible tipping points that could trigger this correction. And based on what we've seen the last few weeks, I think it's clear that the trade war issue could certainly be considered one of those potential tipping points. And oh, by the way, another worry at the heart of all this is the fact that China is America's biggest creditor and could scale back its purchases of U.S. Treasuries as part of its trade war retaliation. What could that mean for interest rates in the bond market? We'll talk about that more coming up just a bit on the show. Now it's time to welcome back Gordon Chang. So what's your best take on all this? Do you really think this is going to end up being a win for the United States? And do you think it could be a double win, as the president indicated it could be?
Yeah, this should be a win for the United States. You know, in the past, the U.S. has had all the leverage, but the one thing we haven't had was political will. The presidents just did not want to use American power for various reasons. One of them is because I think that they understood, well, they thought maybe that the United States didn't have the power. And also, I think that they wanted to integrate China into the international system. And so a goal of American foreign policy was to support China's Communist Party. You know, President Trump doesn't think that way. He understands that we've got the power and he's got the will to use it. So, you know, right now, I think that we should win this trade war. This trade war has been going on for decades. The Chinese have been waging it, and we've been oblivious. President Trump understands that this is a struggle, and good for him, because that's the way we're going to prevail.
Oh, good. I hope you're right. That's certainly for sure. You know, I have to ask you, because you wrote the book, and it was a while ago, but, you know, you talked about the coming collapse of China. How is that? Do you still feel that way? And if so, why? And more particularly, when? I mean, are we getting closer to that brink?
Yeah, I think we're getting closer. You know, that book was released in 2001, in the middle of July 2001. And I said in the book, 10 years, the Communist Party would fail. So I'm out of time. A couple things intervened, like, for instance, the 2008 downturn, which helped the Communist Party sustain itself. But what they did was, to sustain themselves, they went out on a debt binge. And right now, China's debt to gross domestic product ratio is probably over 400% when you include the hidden obligations. They're heading to a debt crisis. They're growing at maybe 2%, but they're incurring debt at the pace of 20%. You can do that for a little while in a state-dominated economy like China has, but you can't do it for too much longer. And that's why a lot of people these days are concerned about China's debt crisis.
Well, you predicted that China would collapse by 2011, and I predicted we'd have the third drop in the stock market by 2015. So, you know, God's delays are not God's denials. So we'll be right in time. So I've got to ask you this question then. North Korea, the weapons with North Korea, because you wrote a book on that. What's going on here? Do you think they're going to back down on this? It seems like they're starting to back down already.
This is an issue, everyone says, oh, Kim Jong-un, the North Korean ruler, won't give up his nukes. Well, that's true, but only under the current set of incentives that he operates under. This is really a President Trump question, because we have the elements of national power to disarm him short of the use of force. But it will take a lot of political will, which no president up to now has shown. And that is basically imposing severe costs on Moscow and Beijing because of their support for Kim Jong-un. If we're willing to do that, I think we can get to a very good place on North Korea, them giving up their weapons and missiles. But if we don't do that, I think we're going to be in a very difficult position.
Quite interesting. Gordon, time flies when you're having fun. It's been a pleasure on our talk today. I really appreciate you being with us. And you too, stay with us. We'll be right back. We have a lot more today on the income generation. We'll be right back after the break.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
A bit earlier this year, we did a whole show focusing on interest rates. And at that time, the potential threat for rising interest rates was being blamed for most of the market volatility that we were seeing then. In fact, it was one of the main issues blamed for the 10% market correction in early February that ushered in this pattern of volatility that exists today. Of course, the direction of interest rates remains a concern. And as I pointed out earlier, the effects of a full-blown trade war could dramatically affect interest rates going forward. As mentioned, China has suggested it could scale back its purchases of U.S. Treasuries as a retaliatory move in the trade war. The decreased demand could lower values and send long-term rates higher. On the other hand, there's a pretty good reason to believe China would never actually follow through on that threat. Why? Because by doing so, they would hurt their own balance sheet by driving down the price of these bonds. At the end of the day, they're trying to collect interest on their money. And with so many European countries who are theoretically less stable than ours and paying less interest on their bonds than ours, China doesn't have many good options. So I believe it doesn't seem likely, for instance, that they're going to go out and buy Italy's bonds instead, or Spain's bonds, take more default risk to earn less interest, just to spite us. But even if that were to happen, there's also a chance that domestic investors fleeing the stock market could rush to bonds and offset the impact of China's move. This thing we call a flight to quality could keep long-term interest rates stable or even drive them back downward. To some extent, it appears that's already what's been happening as trade war worries have escalated. Now, as you might recall, the interest rate on most bonds, and the 10-year Treasury, for example, trended downward or at least remained stable, keeping bond prices stable for most of 2017. Then in January, the bond market seemed to come out of a coma and finally realized that the rate on the 10-year Treasury yield should be higher. That was due to the unwinding of quantitative easing. With that, the Federal Reserve was selling some $30 billion worth of Treasuries per month back into the open market, increasing the supply of bonds in order to drive prices down and drive interest rates up. That's why the rate on the 10-year Treasury yield jumped from 2.4 to 2.7% in January. And as I mentioned, the spike was largely blamed for the initial 10% market correction in early February. And then over the next several weeks, the rate on the 10-year Treasury yield started to yield and edge itself higher, seeming to confirm Wall Street's fears. But here's where it gets interesting. The 10-year yield peaked at 2.94% on February 21st, and has dropped and has not surpassed that number ever since. In fact, throughout March and throughout April, it's remained lower than it was on Groundhog Day when that first big sell-off began. That suggests that many investors jumping from the stock market as trade war fears increase have been jumping to the bond market, offsetting the Federal Reserve's efforts to drive up interest rates. And if you watched our show on bonds and interest rates, you might recall me saying that I believe that the rate on the 10-year Treasury may possibly manage to make it to 3%, or maybe just a little bit over it in the near future. But I predicted that's going to hit a strong resistance level at that point. And today, I still believe that's true, regardless of whether the stock market goes into a major sustained correction, or it manages to temporarily rebound and even add perhaps another 15 or 20% growth this year. The main reason, as I pointed out then, is because of people like us, everyday investors over the age of 50, that is, the income generation. We are the nation's largest demographic. And as more and more of us shift towards secure, income-based investment options, such as bonds and bond-like instruments, as we near retirement, demand in the bond market must remain strong. And that should keep prices up and hold long-term interest rates in check around or below that 3% ceiling. And if the apparent flight to quality we've been seeing in the past 2 months continues, with investors jumping from stocks to bonds as trade war fears mount, that will only add to the increased demand and potentially even push rates even lower. And again, even if the market does manage to rebound and start temporarily growing again, I don't believe it'll do so at the expense of the bond market. That's because so many of us nearing retirement, already retired, will stay committed to those secure, income-based investment options regardless of market conditions. And all of this, including China's financial incentive to keep buying our bonds regardless of a trade war, is important to remember anytime you hear an analyst or advisor suggesting that a so-called bond bubble is about to burst. In my expert opinion, that's simply not true. It's now time to welcome my next guest, Jeffrey Small, and I'm happy to welcome Jeff back to the show. He has over 30 years of experience as a financial advisor and is a highly sought-after speaker and analyst who can be seen and heard regularly on shows like Fox Business and Bloomberg Radio. He's also the author of the best-selling book, Turning Financial Planning Right Side Up. Jeff, welcome back to the show.
Hey, David, it's great to be here. Thanks for having me again.
Well, it's good to have you, but you've been on the show now, what, 4 or 5 times, and you still haven't gotten the memo that you don't need to dress up and wear a necktie on our show here. What's going on? You he's making me look bad. You know, it's like
This is a patriotic tie. You know, it's red, white, and blue. I kind of was feeling spirited today, so I wanted to be patriotic, David.
show about China, perfect time.
That's right.
So what's your take on all this China stuff? You know, it's been affecting the markets. You follow the markets, gosh, as closely as I do. And these 500-point, 700-point swings, I mean, it's crazy. Do you think it's warranted, or do you think it's a lot of the media? What's your best take on this?
Well, David, we're at the end of an 18-year bull market here, bearish secular pattern. We've been in this for 18 years at a peak. And so at some point the market's going to pull back, but there's lots of things in the market that are causing these gyrations, whether it's rising rates, unsettled political issues nationally or geopolitically, as well as the trade issues really, came to the forefront. But the good news is the street, or Wall Street's really focusing on earnings right now, and that seems to be taking a back seat. The trade issue seems to be taking a back seat a little bit to what's happening in the market, and we hit break even today for the year.
Right, break even. Of course, we're never happy about break even, but I guess when you think about what happened after February 2nd in the markets, Groundhog Day, when the financial groundhog saw its shadow and markets started to drop, all things considered, break even isn't too bad, huh?
Not too bad so far, but the volatility was to be expected. In January, the market went up over 7%. We hit that peak January 26th, and then the wheels kind of came off. And so at some point, the market's going to have some gravity to it. They just don't keep going up.
Okay. Now, you heard Gordon Chang, as all of you heard Gordon Chang. What's your thoughts? Do you think that we've got the upper hand here, that we're eventually going to improve our situation with this? Or do you think this tit for tat is just going to end up being a break even? Every time we raise ours, they raise theirs, and nobody wins.
Well, the trade balances are so imbalanced right now with what's going on. We've been the doormat of trade for the last 50 years in this country, and finally somebody's rising to the top to come out and say, look, we've got to fix this. And it takes a deal maker, somebody that's business-minded, like a President Trump, to turn around and fix this. So yeah, I agree with Mr. Chang. I think we've got complete leverage to be able to turn this around. And he could be the first president in 50 years that's done a trade deal that benefits America and denuclearizes the North Korean and South Korean peninsulas.
So you think it's the art of the deal? Basically, the principles in the art of the deal are going to get him to make this negotiation successful for our country. If that happens, then, we've talked before about the secular cycles in the market, and that probably means that the market's going to go up. And this could very well be the first time we recovered from a secular bear market in 2013. Because, do you feel that way? Because the reality is, if we can get this trade deficit, squared away and balanced again, then the reality is that it's good for the stock market.
Well, there's no doubt it'll be good domestically. That there's a good chance that could happen if we can fix the trade issues, but it'll take time for that to ripple through the economy to see the benefits to the bottom line of course, our multinational corporations that are like the S&P 500 or the Dow Jones.
And quickly, in the 20 seconds or so we have left, what do you think about this risk of they're stopping to buy our bonds and what that does to interest rates? Is that a concern of yours, bottom line, or do you think that that's all rhetoric?
It's really all rhetoric. China really is forced to buy our bonds if they want us to buy their goods and services. It's a symbiotic relationship. So that will stay in play. That won't change at all.
That'll stay in play for a long time. Well, I know you drove down here. I know you plan to spend some more time with us, so stay with us. And you stay with us also. We have a lot more from my good friend, Jeffrey Small. We come back after the commercial break. Stay with us. We'll be right back with the Income Generation. Most people have heard the environmental slogan, think globally, but act locally. It's a great slogan not only because it's a good, practical piece of advice, it's also good psychologically. And it applies to more than just the environment. In thinking about things on a global scale, it's easy to feel overwhelmed. That can lead to a sense of helplessness, which leads to inaction. We think, what can one person do? So as a result, we do nothing. That same mindset can be dangerous when something like the threat of a global trade war comes along. And this is an enormous issue with huge implications for the world economy. It's only natural to feel a bit overwhelmed by it and to think, whatever's going to happen is going to happen. What can I do? Well, that's where think globally, act locally is once again great advice. Look at the issue not from a global perspective, but from a personal one. That's how you'll find an answer to the question, what can I do? As well as the motivation to do it if you feel as though it's in your best interest. Here's a good way to approach it, step by step. First, sit down with a qualified financial advisor and review your portfolio. If you're retired or within 10 years of retirement, make sure your asset allocation is right for retirement, meaning it's set up to generate income through interest and dividends in the range of 4 to 6%. Second, review your level of stock market risk in light of all the drama and volatility we've experienced since early February. If the trade war escalates and becomes a tipping point for the next major market correction, could you end up getting caught in the downdraft? If the market falls between 40 and 70%, as market history suggests it should, how will that impact your retirement goals? Third, if you determine your retirement is in jeopardy, take action. Work with your advisor to reduce your risk and create a plan better designed to help you meet your financial goals, regardless of market conditions. And as I stressed on last week's show, I'm not ready to say definitively that the next major market correction is already underway or even close at hand. In fact, I'm willing to admit that trade war or no trade war, the market could find its legs again and regain its January peak and even add another 10 or 20% from there. Remember, my forecast for 2018 was that this would be another double-digit year for the stock market, either double digits on the upside or double digits on the downside, with really nothing in between. And I still stand by that prediction. That said, I also believe there's enough technical, fundamental, as well as historical evidence available right now in support of a major market correction, that investors over the age of 50 need to consider the risk-reward trade-off very carefully before investing. Remember the casino analogy I've shared with you before. If you went to a casino and discovered a game where it paid you $15 if you won but cost you $70 if you lost, would you play that game? Probably not. So now think about how that analogy applies to the current stock market. If you decide not to reduce your risk and a best case scenario occurs, that trade war can get resolved and maybe the market rises another 15%. That's what you win if you stay invested and the market rises. But if the trade war becomes a tipping point and the market falls by 40 to 70%, well then that's what you lose. And that's why thinking globally but acting locally or personally on this issue is so incredibly important. In fact, the worst thing that you could do potentially is to allow yourself to feel overwhelmed and end up doing absolutely nothing. If you do that, then it will end up being too late. Now let's welcome back Jeff Small, best-selling author and president of Arbor Financial Group in Melbourne, Florida. Let's say we're wrong. Let's say we're wrong in this trade war. You and I are wrong, Gordon Chang is wrong, and the trade war works against us. It's a net negative. What does that do for us as a country? What does that do for the economy? What does that do for the stock market?
Well, definitely will undermine the market. It's part of the reasons why we pull back 9–10% here from the January 26th motion forward in the markets. And so it'll rattle investor confidence, it'll rattle investor sentiment, and it'll change the stock market dynamic.
Mm-hmm. And, you know, interest rates, okay? What do you think? In that case, again, if all of a sudden we're importing Chinese goods, we're spending a lot more money to do so just because of the tariffs and so on, that causes inflation, right? So what do you think that'll do to interest rates? Do you think that can cause interest rates to start to accelerate upward?
Well, if there's no demand for our bonds, absolutely. We could be stuck. I mean, if the United States falls out of favor and they stop buying our bonds internationally, what happens? Rates have to go up. That perfectly makes sense. And so the Fed's already on a track to raise rates, and so right now we have a reprieve on rates, and so rates have actually fallen about as much as they raised them a couple weeks ago. And so the reality is when rates start to move back up, regardless of what happens with our international favoritism on bonds or not, China buying them or not, we will see the market start to take heed as corporate profits start to get squeezed as debt goes up.
And we have to come up with $1.1 trillion just to finance this year's deficit. So with $1.1 trillion, you know, does it ever end? You know, in the 30 seconds we have left in this segment, do you think that we can actually grow ourselves out of the deficit, or do you think it's
going to be really hard, Dave, because we've got 600 to 800 billion of treasuries that we're selling out through quantitative tightening as the Fed decides to do what? De-escalate the purchases they made to get us out of the mess in the first place post 2008.
You make a lot of sense, and of course that's why he's a very good friend of mine, and that's why he's also an author of the best-selling book. We'll be right back with more from Jeff Small. We're going to talk about some of those geopolitical things you talked about a minute ago. You stay with us. We'll be right back after the break. Welcome back. We're talking again with Jeff Small, best-selling author of Turning Financial Planning Right Side Up, president of Arbor Financial Group in Melbourne, Florida. Now, I know you have this patriotic tie on and all that, but you see, I'm so patriotic that really I worry about our financial markets here in the U.S. I don't think too much about China's because we don't really invest in China. But were you surprised when you heard Gordon Chang talk about a debt-to-GDP ratio in China of 400% or a GDP growth rate of less than 2%?
I really wasn't shocked by that at all, and that's not the first time I've heard it. I mean, China's books are really cooked. They've over-engineered their economy, they've leveraged out, they're maxed out. They really need to go through a severe financial restructuring if they want to be considered to really grow their economy going forward. At some point, they're going to have a bigger financial crisis than we will in the near future.
You know, all these people sitting here, a lot of the liberals, you know, those that aren't watching the show, would say, well, communism works. Look, they're getting steady growth of 7 or 8% over there in China. Communism is great. So I guess when it comes right down to it, communism isn't that really that great, is it, Jeff?
No, not even when you combine it with free market economics.
Yeah, that's right. That's right. Hey, speaking of that, you know, you heard me allude with Mr. Chang to our good friend, the Rocket Man over there in North Korea. And he was not quite as optimistic about a positive outcome there in terms of disarmament. You know, what if that escalates? You know, that's one of those geopolitical concerns you talked about a couple segments ago. If that escalates, you know, do you think that could be a tipping point to cause that third major stock market drop that, you know, we've been talking about now for a long time on the show, and then of course you and I have been talking about?
I don't know if it would cause a stock market correction, Dave, but it certainly will cause the market to get jittery the same way it did with Trump's tweet about launching missiles, and they're coming right away. And so I think what you've got to look at, there's lots of posturing going on from our country's perspective and leveraging out Russia and leveraging out China to get what you want from North Korea to denuclearize that entire peninsula, because we really can't allow him to have nukes. That,
Right,
you know,
of course
he's
not.
a wild card.
Right, that's right. Okay, so 30 seconds or so we have left. Go into your area of expertise, right? All of our income generation members, age 50 and over, they hear all this rhetoric on TV, markets bounce around 700 points, 50 and over. What do you tell them? What's the best advice to them in terms of how they react to all this news?
Well, the best advice for them really is to make sure that they're going to avoid the next downturn, because zero becomes your hero. Make sure you find a way or find an advisor that you can work with that's going to show you how to be market bulletproof at this point in time. The next 20%, 25% upside is not going to help you if you go through the downturn when it happens. And it will happen at some point. Nobody knows when, not even the brightest minds on Wall Street.
So it sounds like you're saying cash is king, which I like. And with that in mind, you know, I'm going to stop and have dinner on the way home. I forgot my wallet. Can you lend me a couple bucks since cash is king?
I'll take you out and buy you dinner.
Come on. There we go. That's even better. I love it. Dinner with my good friend Jeff Small, and best-selling author. All right, stay with us. We'll be right back. Thank you, Jeff. And thank you also. We'll be right back for a final segment here on the income generation. As you could probably imagine, creating content for this show has been somewhat challenging the last 2 months, given how quickly things keep changing in the financial markets. Naturally, the markets always fluctuate to some degree, but the dramatic levels of volatility we're experiencing now definitely are not typical. As technical analysts have pointed out, they're actually similar to the patterns of volatility we saw before the last 2 major market corrections. So does that automatically mean the next correction is imminent? Of course not. No one can say for sure that the threat of a trade war is going to be a tipping point for that third major market drop that we've been discussing for a long time. As we saw on today's show, there's actually a scenario in which this whole situation could be good for the United States, and we could end up reining in our trade deficit, boosting our import industry, and adding to the GDP, all of which would probably help get the stock market back on track. At the same time, a trade war could force interest rates up, or if a correction takes hold and a flight to quality continues, actually drive them further down. The point is that no one has a crystal ball, and all these different scenarios and potential outcomes can seem absolutely overwhelming. So just remember to think globally, but act locally. Consider the potential impacts, both good and bad, from your own household, your own family, and your own life. Decide if you need to take action, and if you do, then take it. Thanks for watching. If you're close to retirement and you really want to know how to protect and maximize your money, it's absolutely essential that you stay informed and up to date. And right here is where you can do it on the Income Generation. I'm David Scranton. Thanks again. We'll see you next week.
Read David J. Scranton's groundbreaking new book, Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.